Hello guys, welcome to another video. This is lecture number 3 of IAS 33, which covers EPS, earning per share. This is your financial reporting tutor, Uzair Awan, and in this video we'll be continuing with EPS. Now in lecture number 2, we looked at the right issue, then we did few questions of right issue, right? And then we looked at cases where there were multiple issues including full market price issue, right issue, bonus issue in one particular question. So we did a lot of questions like these so that you guys can get a good grip on that area. Now this is lecture number 3 and there is this area of diluted EPS which we have to cover. So it's not restated EPS. Restated EPS was something else that we have already covered. This is diluted EPS. Now diluted EPS is basically when your EPS is about to fall and you already know that it's going to fall. So what you do is that you inform your investors that it's basically you just calculate that in advance, right? This is the most simplest way I can tell you, that you just calculate the dilution of EPS that you already know will happen in advance. You calculate that in advance, all right? So for example, we have potential shares. Now what are potential shares over here? You can see that potential shares are those agreement which are already signed and through which company is bound to issue new ordinary shares in future. So potential shares are those agreement which the company signs. For example, the company signs today that okay, today we are signing this agreement, then in the future we'll be issuing this amount of new shares. Okay, so since now they have already written in the agreement, so we know that that is about to happen. Now just tell me one thing, what will happen if new shares are issued in the market? If new share are issued in the market, what will happen? Will your EPS fall? Obviously it's going to fall. Why? Because we know that the formula for EPS is that you take your earning, your profit, and you divide it by the number of shares. So if my number of shares are about to increase in the future, would my EPS not fall in the future? Obviously it would. And since my EPS would fall in the future, that is what we call the diluted EPS. So what I want to do is that I want to record the decrease in EPS today. Now, if your question is, why do you want to do that? Why do you want to record the decrease in EPS or the diluted EPS, what you call today? Why do you want to do that today? So my answer to you is because of the prudence concept, right? So that's what the prudence concept has been telling us from the very beginning, that you should record all the future liabilities today, right? Or everything that is supposed to, anything that is not that is against your company, you should account for it today, right? So diluted EPS is something that is not for good for our company. So according to the prudence concept, I will have to account for it today. Okay, so basically it's just like a what if scenario. It's like, the second point what I've written over here, that it is basically, you can see over here, it's basically a what if scenario. So it's basically a what if scenario, that what if new shares are issued into the future because of the agreement that we did. What will happen to our EPS? What if those shares are issued? What will be the outcome then? What will happen to our EPS? So we just, do a what if scenario, that okay, if that happens, what will be the impact on our EPS? So we just calculate that today. And why? Because of the prudence concept. Okay. So I hope this is clear, the concept about the diluted EPS. Now, if your question is that, okay, you told us that uh, company can do agreements which will bound them to issue new ordinary shares in the future, but what kind of agreements are you talking about? Do you have any examples? So I said yes, I do have two very famous examples. Not something that is new. You guys already know about convertible loan notes. You already know about share options and warrants, right? We have already learned this in the previous papers, right? So nothing new. And these two are the examples of the potential share. Why? Because if you guys remember, in convertible loan notes, we used to give our investor this choice, that at the redemption date, you can either take back your loan or you can convert that loan amount into shares. So if they convert that loan amount into shares, then we will be bound to issue new shares, correct? We will be, as a company, bound to issue new shares, correct? So that's why convertible loan note is a classic example of potential shares. Okay. And the second example is the share options, or what we call the warrants. So share option or warrants, some of you might already know, is basically when the company issues new shares for the employees. So it's usually given to motivate the employees so that they, have this sense of belonging to the company, and they remain with your company for a long time rather than leaving the company after a few months or few days. Okay. So if you want the employees, if the employees are really important for you, you want them to stay with you, the company sometimes gives them uh, shares of the company so that they can feel a little bit, you know, kind of a owner of the company, or they can just have this sense of belonging into the company. Okay. So these are two classical examples: convertible loan note and share options warrant, which are basically an examples of potential shares. So potential shares bound the company to issue new ordinary shares in the future, and it is because of these potential shares that the shares are the amount of shares in issue are tend to increase, and because of that the EPS is going to fall, which is called the diluted EPS, and we record it today because of the prudence concept. So this is the whole idea. I hope this is clear. Okay. So let's now take an example, and with the help of the examples we are going to understand this just like the way we have been understanding all the things before it, right? So here's a question. What does the question say? The question says that there are number of shares at the start of the year which are 10,000. Then at the end of the year, we have the same number of shares. So number of shares has not changed. Okay. Because there is no full market price issue, there is no bonus issue, there is no right issue. Okay. So therefore the number of shares remain the same even at the end of the year. And our earnings for the entire year are 50,000. Okay. Now what they're saying is that this is the whole scenario. But the company had in issue 7%, 6,000 convertible loan notes. The company had in issue 7%, $6,000 convertible loan notes, which can be converted into 30 shares. And the tax rate is 35%. What you guys have to do? You have to calculate number one, the EPS, the basic EPS, right? And number two, the diluted EPS. Okay. Please do not confuse diluted EPS with restated EPS. Restated EPS was something else. We have already learned that. It's done and dusted. Okay. Now we are looking at diluted EPS. So second part asks you to calculate the diluted EPS. All right. Okay, guys. I just have to make a correction over here. Okay. I just thought of adding something which is very important. So it says company had an issue 7%, 6,000 convertible loan notes, right? And each $100 loan note is convertible into 30 share. Okay. Each $100 loan note, or let me just write like this, can be converted. Okay. Can be converted into 30 share. Tax rate is 35%. Okay. So what do we have to do? We have to calculate the EPS and diluted EPS. So let me just first calculate the EPS. So EPS is equals to the total earning for the entire year, which is 50,000. You divide it by the number of shares, which are 10,000, which haven't changed at all during the year, right? So that's gonna give me $5 per share worth of EPS, right? Now the question is that why there is going to be a diluted EPS, because the question says that you have convertible loan notes in issue, and we know that convertible loan notes are a classical example of potential shares where you issue new shares in the future, where you are bound to share new shares in the future, because of which your shares would increase and your EPS would decrease, right? So we need to account that today. We need to account for that today. Okay. So how do we calculate the diluted EPS? Now this is something new that we have to learn. So focus on the screen very carefully. First of all, I'm going to calculate the number of shares from this conversion. If I do the conversion, how many shares am I going to get? That is what I have to do. So I know that I have $6,000 worth of convertible loan note, and each $100 will be converted into 30 shares. So I do 6,000 divided by 100 into 30, right? So 6,000 divided by 100 into 30, that gives me 1,800 shares. So I'm gonna get 1,800 new shares. I can convert this into 1,800 shares. Okay. So 6,000 divided by $100, because it says each $100 loan note can be converted into 30 shares. So I said, okay, I mean, the total worth of the convertible loan note is 6,000. So 6,000 divided by 100, I will have the amount of how many loan notes I have, and then I can convert it into 30 shares. So I'm going to get my number of shares, which are 1,800 shares. Okay. So that's the first thing always that you do, that you calculate the number of shares from conversion. Then I'm going to calculate how much interest. So I'm going to calculate the incremental after tax saving. Okay, you always calculate the incremental after tax saving. Now how do you calculate your tax saving? You will see that okay, it's $6,000 and 7% interest, right? So I'm going to take 6,000 into 7%. Okay, that's going to give me $420 interest. And then how much will I save from it? The question says that the tax rate is 35%, so that means 35% will be gone. How much will I be able to save? 65%, right? Because 35% of 420 will go to the tax department, right? So how much will be left with me? 65, right? If 35 goes to the tax department, you'll be left with 65% of 420, right? So 65% of 420 is 273. So this is the amount that I'll be left with. Okay. So 1,800 shares and $273 worth of tax saving. Okay. Now remember, now we are going to calculate a diluted EPS. And one thing about diluted EPS that you guys need to remember always is that diluted EPS is a continuation of EPS, of your basic EPS. Okay, so diluted EPS is a continuation of your basic EPS. So your basic EPS was $5 per share, right? Or if I take the fraction before simplifying, it was 50,000 divided by 10,000. Okay, so I'm going to write over here 50,000 divided by 10,000, my basic EPS, and I'm going to continue this to calculate my diluted EPS. That's why I say that diluted EPS is just a continuation of the basic EPS. Okay, so basic EPS was 50,000 divided by 10,000. So I write 50,000 divided by 10,000. Now how much more money am I saving? 273. So you will add that over here. And in the denominator, how many new shares? 1,800. So you will add it over here, right? And with that, you will have your diluted EPS, which should be equal to $4.26 per share. Okay, so you can see that your EPS was $5 per share, and because of these conversions, because of these convertible loan notes, your EPS has fallen to 4.26. So yes, it is indeed a diluted EPS, right? So this is how you solve these questions. Let me just zoom out. You guys can take your time, okay, and have a good look at the question as well as the solution, because this is how you'll be solving convertible loan note question from now onwards. And it's not that difficult also. So you can see that first of all, we calculate our normal basic EPS, and once we have our basic EPS, then we continue the basic EPS to calculate our diluted EPS. Okay. Diluted EPS is the continuation of the basic EPS. And the way that you tackle the convertible loan note is that first of all, you calculate the number of shares from conversion, then you calculate the incremental after tax saving, and then you add the incremental tax saving in the numerator while you add the new shares in the denominator, and then you divide to get your diluted EPS. Okay, so this is the overall working. You have the question and the solution in front of you. You guys can copy it. You guys can take a time to get a grip of this. Okay, and if there is something that you guys don't understand, then you can just wait for the next question. I hope that when I explain the next question, which will be same, then you guys would have a more clear understanding. Okay, having said that, let's move to our next question now. Okay guys, so this is the next question. You can have a look at the question. You can try to solve this first yourself because it's going to be solved in the same way like the previous question that we did. So if you guys have copied down the first question, you can use the solution of that to do this question also. Okay, so try this and then you can just resume the video to see me solving it. So let's start with the question. Let's see how to solve this question. So it's going to be solved in the pretty much the same way that we did the previous question. So the solution is number one, we need to calculate the basic EPS. So it's the most simplest thing. You take your earnings, 60,000 for the year, you divide it by the number of share, which hasn't changed at all, right? So I'm gonna get my basic EPS, all right, which is gonna be $3 per share. Okay, so that's my basic EPS. Now what I have to do, I have to calculate the diluted EPS. So how will I calculate the diluted EPS? You guys know that number one, you need to calculate the number of shares from conversion. Okay, and what does the question say? It says that it's $8,000, and for each of 100 you are getting 40 shares. Okay, so 80,000 divided by 100 into 40, that is equivalent to how much? 3,200 shares. Okay, and then we have to calculate the interest percentage. So 8% times the 8,000, so that gives me an interest rate of 640. But out of the 640, 30% belongs to the tax department. So how much belongs to me? Just the 70%, correct? So that's going to be 448. Okay, and now I am good to calculate my diluted EPS. So diluted EPS is equals to, what's the basic EPS? 60,000 divided by 20,000, right? And like I said before, diluted EPS is the continuation of the basic EPS. So we wrote our basic EPS. And now how much more money are we saving? 448, right? And how many shares did we get more? We got 3,200. Okay, so 60,000 plus 448 divided by 20,000 plus 3,200. So that's 2.61 dollar per share. Okay, 2.61 dollar per share. So that's our diluted EPS. That's our diluted EPS. So if you look at our EPS, you can see it was $3, and because of these issue that will happen in the future, our diluted EPS will become 2.6, right? So our EPS is going to fall. It becomes 2.6. So it is indeed diluted, right? So again, this is something which has not happened so far, but we are just calculating it right now to see that what if this happens, then what will happen to our EPS. So this is what will happen to your EPS. It's going to fall to 2.61. Okay, so you're just noting these things now because of the prudence concept, right? So this is the whole idea behind it that we discussed before. And now you guys have the question in front of you. You guys have the entire solution in front of you. You can see that it's pretty much the same as the previous question. And this is exactly how you will deal with any convertible loan note in the exam. If you get a convertible loan note question where you have to calculate diluted EPS, it's exactly how you will solve it. Okay, there is nothing more to it. It's the same. Okay, so those who try to solve it, I hope you guys got the correct answer. And if you didn't, then this is the solution. You can cross check, you can see what went wrong. Now we are going to move forward, and now we are going to look at the second potential shares. So right now, what are we looking at? We are looking at the first example of the potential share, which was convertible loan note. That if convertible loan notes were to happen in the future, what will happen to our EPS and how do we calculate it, right? So we were looking at the calculation part. Now we will look at the share option, that if there's a share option instead, how we will do the calculation to calculate our diluted EPS, right? So that is now what we have to look at. So now we'll be looking at share options. Okay. And I told you guys, you can write it down also, that share options is when the company promise to issue a fixed number of shares at a fixed price through an agreement, right? And it is given sometimes to motivate the employees for the alignment of interest, for them to feel a little sense of belonging, right? Just the way that I taught you. So that is what the share options are. You can write it down. If you guys want, I can repeat it one more time. That share options are um, when the company promised to issue a fixed number of shares at a fixed price through an agreement. Fixed number of share at a fixed price through an agreement. Okay. It is given sometimes to motivate the employees, for them to feel a sense of belonging, and so on and so forth. Okay. So let's look at an example question. But before we look at an example question, please remember that share options also have two elements attached to it. Number one, it has an element of full market price issue, okay, and it has an element of bonus issue. Remember this, okay? Why do I say that? Because again, you are issuing new shares, you are issuing new shares, right? Through the share options, you are issuing new shares, so you get money. So that's the full market price issue element, right? But what you do is that you basically give them at a fixed price, right? That's what I made you write down. That company share options is when the company promised to issue a fixed number of share at a fixed price. So that means no matter what the market price is, your price is already decided, correct? And it can be less than the market price. So that would mean that there would be an element of bonus issue also, correct? So let's look at a question now. And obviously from the question, we get more clarity of things, right? So we have our beginning of the year, 1st January 8. The number of shares in issue are 20,000. Our earnings for the year are 10,000, or let's do 100,000. Okay. And then it says that the number of shares in options are 10,000 shares. And it gives us the exercise price, which is $3. It gives us the average market price, which is $5. What are we required to do? We are required to, number one, calculate the basic EPS. Okay. And number two, we are asked to calculate the diluted EPS. All right. So what we have to remember, that share option has both full market price issue element also and bonus issue element also. And from this question, this concept is going to be cleared even more. Okay. So first of all, if I calculate my basic EPS, because that's the first requirement of the question, it's very simple, right? How will I do that? 100,000 divided by the number of shares, 20,000. So that's going to give me $5 per share worth of EPS, right? Now I have to calculate the diluted EPS. So now in a diluted EPS, there is a share in option. It says number of shares in option, right? It's not convertible loan note. Now we are looking at share option. So the working would be different, obviously, right? Now, what you guys need to look at is that the number of shares that we have in option, as an option that we can take, are 10,000, correct? And now what we'll do is that we are going to calculate the free element, because see, if we talk about the full market price issue, you guys know that because of the full market price issue, our EPS does not fall, right? Because of the full market price issue, our EPS does not fall because the share are issued, but you get more money also, right? So it does not fall because it's a full market price issue. You do not do a discounted issue. You do not do a bonus issue. It's a full market price issue. So your EPS does not fall, but it is because of the bonus issue. It is because of this bonus issue that your EPS false, right? Which is something we have already discussed in our previous lecture. It is because of this bonus issue that your EPS falls, because in bonus issue shares, your shares in the denominator would rise, but your numerator would not rise. Therefore, your EPS would fall. So the problem, right, or the, you can say, reason for dilution in EPS because of the share option is because there is an element of bonus issue in the share option. The full market price issue has nothing to do with it because it will not cause your EPS to fall. So the all the problem is related to this bonus issue. So what we do is that we say that okay, let's take out this element of bonus issue. So what we do is that we say number of share in options are 10,000. This is the one that we are getting. Now I'm gonna ask myself, okay, what if I buy this 10,000 shares directly from the market? So I know that I have 10,000 shares. Okay, the average market price is 5. All right, and the exercise price is 3. So I just take the number of shares, I multiply it with the exercise price, so it's gonna give me the value that I'm paying to actually get these shares, a discounted price $3 which I'm paying to actually get this number of share, and I just divided by 5 to see that if I got this same if I use the same money to buy from the market instead of from this company at a discounted price, how much shares would I get? So you can see I'm gonna get 6,000 shares, right? If you subtract this 6,000 with this 10,000, you're gonna get 4,000 shares, which is actually the free shares, right? This is the free share. This is the free element I was talking about, right? So let me just repeat it again. The shares that I'm getting through this option. Which option am I talking about? This option, the option of share options, right? This one. If I exercise this share option, I am getting 10,000 shares. I will get 10,000 shares. This is what the company would give me. Okay. Then I ask myself that, okay, what if I would have bought this 10,000 shares directly from the market? So I said that would have given me 6,000 shares, because if I have 10,000 shares and I'm buying that at a price of $3, so that's $30,000 that I'm investing. So if I invest that same $30,000 and buy from the market, so the price of one share of the market is $5. So 30,000 divided by 5 would give me the number of shares, 6,000 shares, which I will get from the market. So 10,000 minus 6,000, which means I'm getting 4,000 shares more than I would have gotten if I would have taken or bought the shares from the market, because I would have gotten 6,000 shares if I have bought from the market, and the company is giving me 10,000 shares. So that means that this 4,000 share company is giving me for free, right? So this is the free element that we are talking about, and this is what is gonna cause our EPS to fall, not the full market price issue. So since the full market price issue is not going to do anything, we will ignore it. We are just going to focus on the bonus issue. Okay, and the bonus issue or the free element in this question is this, and this is the calculation that you guys will follow from now onwards. Whenever you have a share option question, you will always calculate the free element, and the way to calculate free element is this, that you see, okay, how many shares is the company offering us right now, and what if we would have invested the same money and bought from the market? How many shares would we have gotten then? We would have gotten only 6,000 shares. So that means company is giving us 4,000 free shares. And this is what going to cause the dilution in the EPS in the future. Okay, so if I basically calculate my over 20,000. Now, since we are dealing with the bonus issue or the free element of this question, there are going to be no money. So nothing in the numerator, just new shares in the denominator. So that's 4,000, right? Nothing in the numerator because we're getting no new money. So 100,000 divided by 20,000 plus 4,000, that is going to give us a diluted EPS of 4.167, which can be rounded off to 17. So 4.17. Okay. So this is my diluted EPS. So you can see from $5 now it has become 4. So it is indeed a diluted EPS because it has fallen, right? So this is the overall question. This is the overall working. I'm going to zoom out again. You guys can have a look, complete look at the question and the solution. Copy it down if you guys want to, right? And then we'll look at another similar question. Okay guys, so this is the next question in front of you. You can pause the video, take the solution of the first question as your reference and try to solve this first yourself. It's going to be exactly the same. Okay, and then you can just resume the video to see me solving. Okay, so I hope you guys would have tried this question first yourself, and now I'm going to solve this. So first of all, I need to calculate the basic EPS. That's the first requirement of the question. What are the earning? 150,000, right? And what's the number of shares at the start of the year? 50,000. So that's gonna give me $3 per share worth of EPS, right? Now I have to do the working for diluted EPS. What does the question say? That there are shares and options. So the shares that I'm getting, if I go for the options, are 6,000 shares, right? And if I buy the same shares from the market, then how much is it gonna cost me, right? This is what we calculate. So 6,000 into 6, because that's the exercise price, divided by the market price, which is 10. So that is equal into 3,600 shares. That is what I'm gonna get if I buy the shares from the market instead. Okay, so if I subtract that, I can get the free element, which is 2,400 shares. So 2,400 share is the free element. So if I calculate my diluted EPS, you guys know that it's just the continuation of the basic EPS. So basic EPS is 150,000 divided by 50,000. And how many new shares are we getting? 2,400. So you just add that, and then we'll have our diluted EPS as $2.86 per share. Okay. Okay. So this is the complete question and solution in front of you. You guys can copy it down. And this is the end. This is it. Now we just have to discuss 2 or 3 important things, and then this lecture number 3 is done. Okay guys, now I want you to leave your pen, pencil, register, everything. Just focus on the screen and listen to what I'm saying first, and then you can copy it down. Okay, there are just 2 to 3 things that we have to discuss, and then this lecture is done, our class is over. Okay, but please focus in what I'm saying because this is very important. Now we are discussing the order. Okay, you can see over here I've written order. Now we are discussing the order. That, for example, if you have a question where there's a lot of things happening, there's a bonus issue, right issue, then they have also given you the convertible loan notes or the share options, right? How would you solve the question? So this is the order. This is the order in front of you. Number one, first of all, we always compute the basic EPS, which means that we always calculate the basic EPS. And for basic EPS, we need to find the real event. What do I mean by real events? Like the full market price issue, the bonus issue, the right issue, because these are the real events, right? They are not any assumption of the future that, oh, we are going to do this in the future, thinking about the future and thinking about the impact of something that would happen in the future today, right? So those are not real events. The real events are the full market price issue, the bonus issue, the right issue. So first of all, you calculate your basic EPS just like the way we learned in the first and the second lecture, okay? That's the first thing you're going to do in the question. So if a question has convertible loan notes, it has share option, just ignore it. Just ignore it, okay? Just ignore it for a second. For a second, just ignore it. Just calculate your basic EPS first. Just calculate your basic EPS first by using the full market price issue, bonus issue, right issue, whatever is given to you in the question. Just calculate the basic EPS first. Once you have your basic EPS, now you look at the question and see what does it say more about the convertible loan notes or the share option, and then you solve it respectively, just like the way we have learned. We have seen the working of convertible loan notes also. We have seen the working of share option also. So you have to do the working accordingly, and then you can calculate your diluted EPS. So this is the order that you guys have to follow in order to do the question correctly, because diluted EPS is the continuation of the EPS. So first of all, you will always calculate your EPS, and for that you are going to look at the real events. You're going to ignore all the other things, okay? So this is the first thing, and once you have your basic EPS, then you can look at the other things in the question and calculate your diluted EPS, okay? So this is the order. You guys can pause the video and copy it, okay? Now, one last thing that I need to discuss with you guys is that there can be a case where you have multiple conversion option. Okay, so I'm talking about the convertible loan note. In the question of convertible loan note, there can be a question where they give you multiple conversion option. What does that mean is that, for example, it will say that 7% convertible loan note of 10,000 can be converted into 4,000 ordinary shares or 6,000 ordinary shares or 9,000 ordinary shares. So if you have a question like this where you have multiple conversion of shares, what will you do? So I say go for the worst. Go for the worst, because that's the whole idea of prudence concept, right? Whatever worst is about to happen in the future, you record it today. So always go for the worst. So now when I say go for the worst, a very common question that I get from the student is that should we sit in the exam and then account all of these individually, like we do the working for 4,000 shares, then 6,000, then 9,000? So the answer is obviously not, because that's going to take a lot of time. And if you just think logically, it's very simple that instead of doing everyone individually, you can just see whichever shares or whichever option has the more number of share or greater number of share, that is the one which will be worst. Why? Because you guys know that the formula of EPS is that you take the profit and you divide it by the number of shares, right? So you have shares in the denominator. So whenever you have to decide, you can just see the number, you can just see the option with the greatest number of share, which in this case is 9,000, because 9,000 share would increase the denominator, which will decrease my EPS. So the greatest decrease in EPS would be through the greatest number of shares in issue, which is 9,000 instead of 4 or 6,000, right? 4,000 will also cause my EPS to go down. 6,000 will also cause my EPS to go down, and 9,000 will also cause my EPS to go down. But which will have the greatest impact? 9,000, because it's the greatest number, right? So that's the whole point. Okay, so you always go for the option with the greatest number of share, because that will give you your worst case scenario. Okay, so this is just few things that I needed to discuss, and with that our lecture number 3 is completed. If you guys have any question, you can comment in the comment section, or you guys can see the number, my WhatsApp number on the screen. You guys can WhatsApp me and I will answer your queries as soon as possible. Having said that, I think there would be just one class more, and it would be not very big. It would be a class of like 15 to 20 minutes, because I just need to discuss about few limitations of EPS. So just the theoretical part of EPS which is left, I just need to discuss that a little bit, and then this entire IAS 33 would be completed, your EPS would be completed, and then you guys would be good enough to attempt the question present in your kit or the study hub. Okay, you guys can easily do that, do these questions, okay, if you guys have taken all the lectures properly and copied down everything and practice everything, revise everything, more importantly. Okay, so you guys can easily do the questions in the kits and the question in the study hub. Easily you can do that. Okay, but make sure to start reading the EPS chapter from the Kaplan study text or from the study hub. Okay, you guys need to do the reading. Okay, so make sure to do the reading as well, and please share, like, subscribe this channel, and I'll meet you in the next video. Till then, take care. Goodbye.